Markets are shaking tonight, not because of one headline, but because several stories are colliding at the same time. A powerful push to cut China out of the global system is suddenly losing momentum. A key policy narrative is breaking down in public. At the same time, new cracks are appearing in United States jobs data that most people never see on the front page. And while the headlines keep talking about optimism and growth, major United States tech stocks are quietly bleeding value. This is not noise. This is not random volatility. These events are connected. In the past few months, officials and media voices have promoted the idea that the United States can pressure, isolate, or even economically cancel China without serious consequences. That idea is now being tested in real time. Behind closed doors, parts of that strategy are already retreating. Some plans are being delayed, others are being softened, and the markets are reacting faster than politicians expected. At the same time, the official job story does not match what is happening beneath the surface. On paper, employment looks stable. But when you break down the numbers, the quality of jobs is falling. Full-time work is shrinking. Temporary and part-time roles are rising. Revisions quietly erase previous gains. Certain sectors are shedding workers while others survive only on government support. These details rarely make headlines, but they matter more than the top-line number. Now, add technology stocks to the mix. For years, tech carried the market. Artificial intelligence hype pushed valuations to extremes. Investors were told these companies were untouchable. But rising costs, weaker demand, supply chain pressure, and policy risk tied to China are hitting tech from every direction. Some of the biggest names are already down sharply from their peaks. Others are being held up only by hope and momentum. Here is the part most people miss. These stories are not separate. The push to confront China affects supply chains. That hits technology companies first. Weak tech performance feeds back into hiring. Slower hiring weakens consumer spending. And when spending slows, the jobs data starts to crack, even if officials try to smooth it over. In this video, you will learn what the cancel China push really looks like behind the scenes and why parts of it are already failing. You will see how jobs data can look strong while workers fall behind. You will understand why tech stocks are under pressure even when the market narrative sounds confident. And most importantly, you will see how these trends connect into one larger economic story. We will break down the claims. We will separate facts from messaging. We will focus on the numbers most people never hear about. By the end of this video, you will understand why recent market moves are not an accident and why the next phase could matter even more. If you want clear explanations without hype, you are in the right place. Welcome to the channel. If you value calm, data-driven breakdowns of what is really happening in the economy and markets, subscribe now and stay with us until the end. The phrase cancel China has been showing up more and more in political speeches, financial commentary, and market discussions. It does not mean cutting China off overnight. It refers to a broader strategy aimed at reducing China's role in global trade, technology, and finance. This includes limiting access to advanced technology, shifting supply chains away from Chinese factories, raising tariffs and pressuring companies to move production back home or to allied countries. Supporters frame it as protecting national security and domestic industry. Critics see it as economic isolation that risks serious damage. This strategy did not appear out of nowhere. It builds on years of trade tensions, sanctions, and restrictions. What is different now is the scale and the tone. The language has become more aggressive. The goals sound more absolute, and markets are paying close attention because even small policy shifts between the United States and China can move trillions of dollars. At the center of this conversation is Scott Bessent, the United States Treasury Secretary. He is not a career politician. He comes from the world of global finance and investment. That background gives his words extra weight. When he speaks about China, markets listen. Investors read his comments not as theory, but as signals of real policy direction. His role places him at the crossroads of government strategy, financial stability, and investor confidence. Bessent has spoken openly about reducing dependence on China while keeping markets stable. That balance is difficult. Treasury decisions affect interest rates, capital flows, currency markets, and government debt. Any misstep can ripple across borders. When messaging sounds tough, but policy actions appear mixed or delayed, uncertainty grows. And uncertainty is something markets dislike more than bad news. What is at stake here goes far beyond trade headlines. The global economy is deeply interconnected. China is embedded in manufacturing, technology components, energy markets, and consumer goods. Disrupting that system affects prices, corporate profits, and employment worldwide. United States workers feel it through hiring decisions and wage pressure. Companies feel it through higher costs and supply disruptions. Markets feel it through volatility and shifting capital. This is why every statement, every delay, and every policy adjustment matters. The outcome influences global growth, job security, and financial stability at the same time. When people hear the phrase cancel China, it often sounds dramatic, even extreme. In reality, it describes a gradual but deliberate shift in policy. The core idea is to reduce how much the United States relies on China for critical goods, technology, and industrial capacity. This includes everything from consumer products to advanced components used in defense, energy, and artificial intelligence. The goal is not a clean break, but a controlled pullback that reshapes global supply chains. One major tool in this effort is tariffs. Higher import taxes are used to make Chinese goods less competitive and encourage companies to source from other countries or produce domestically. Alongside tariffs, export controls play a central role. These rules limit which technologies and components can be sold to Chinese firms, especially in areas like semiconductors, advanced manufacturing equipment, and high-performance computing. Over time, these restrictions are meant to slow China's progress in strategic industries. Another key element is technology decoupling. This goes beyond trade and into research, data, and capital. American companies face growing pressure to limit partnerships with Chinese firms. Investment flows are screened more closely. Supply chains are being redesigned to avoid single country dependence. Even software and cloud services are increasingly divided along national lines. Each step may seem small, but together they change how global business operates. Supporters argue this approach strengthens national security and reduces long-term risk. They believe dependence on a geopolitical rival creates vulnerabilities that cannot be ignored. Critics see something else. They view it as the early stage of an economic war where cooperation is replaced by containment. Instead of shared growth, the focus shifts to blocking access, controlling resources, and gaining leverage. This tension explains why the policy feels unstable. Businesses want clarity, not constant rule changes. Markets want predictability, not escalating confrontation. As the United States pushes to reduce reliance on China, the cost and complexity of that shift become more visible across the economy. The claim of a disaster collapse comes from how quickly markets have reacted to rising trade tensions in 2025. Investors tend to move ahead of confirmed outcomes, and recent policy signals have triggered fast shifts in sentiment. When talk of tougher trade measures increases, traders immediately start pricing in higher costs, weaker growth, and lower profits. That reaction alone can push markets down before any policy is fully implemented. Escalating tariffs play a powerful psychological role. They signal confrontation rather than negotiation. For companies that depend on global supply chains, tariffs mean thinner margins and higher uncertainty. For investors, that uncertainty often leads to sell-offs, especially in sectors already priced for perfection. Money moves out of stocks and into safer assets, not because collapse is guaranteed, but because risk suddenly looks harder to measure. Market movements also became more noticeable after comments from Scott Bessent. His words were closely analyzed for clues about future policy. Even neutral or cautious statements were interpreted as signs that tensions could deepen. In fast-moving markets, perception can matter as much as reality. A single comment can trigger automated trading systems, amplify headlines, and accelerate short-term declines. At the same time, it is important to understand how markets actually work. Stocks move for many reasons at once. Interest rates, earnings forecasts, inflation data, global growth expectations, and geopolitical risks all interact. Trade policy is one factor among many, but it often acts as a catalyst. It does not create every problem, but it can expose weaknesses that were already there. This is why market drops tied to trade news feel sudden and dramatic. They are often the release of pressure that has been building beneath the surface for months. The idea of a hidden jobs crash does not come from a sudden spike in unemployment. It comes from long-term trends that are easy to overlook. Over several decades, trade with China reshaped large parts of the United States labor market. Manufacturing jobs declined steadily as production moved overseas. Entire regions lost factories that once supported stable wages and long-term employment. These losses did not happen all at once, which made them easier to absorb and easier to ignore. Research shows that many workers who lost manufacturing jobs did not find similar roles. Some moved into lower-paying service work, others left the labor force entirely. The economic impact lingered in the form of weaker communities, lower income growth, and reduced job security. These effects still shape today's economy, even though they rarely appear in monthly jobs reports. Critics argue that government reporting focuses too heavily on headline unemployment rates. Those numbers suggest stability because unemployment remains near historical averages. But headline figures do not capture job quality, hours worked, or wage strength. A rise in part-time employment can offset full-time losses without signaling distress in the top-line data. Job revisions often quietly adjust earlier optimism downward. Trade policy adds another layer. When tariffs or supply disruptions hit, companies respond cautiously. Hiring slows before layoffs appear. Temporary contracts replace permanent roles. Wage growth stalls. These shifts weaken the labor market without triggering an obvious crisis. The result is an economy that looks healthy on paper but feels fragile to workers living inside it. This gap between official data and lived experience fuels claims that job losses tied to trade policy are being downplayed rather than addressed directly. Technology stocks sit at the center of modern trade tensions, which makes them especially sensitive to shifts in policy. Many major technology companies rely on complex global supply chains that run through Asia, including China. Components are sourced, assembled, tested, and shipped across multiple borders. When trade rules tighten or tariffs rise, costs increase and timelines break down. Even small disruptions can ripple through earnings forecasts and investor expectations. Export restrictions add another layer of pressure. Limits on selling advanced chips and equipment reduce revenue for companies that spent years building global markets. Semiconductor controls also affect long-term planning. Firms hesitate to invest when access to key customers may vanish overnight. Retaliatory measures from other countries deepen that uncertainty and raise the risk of further restrictions. Investor confidence reacts quickly to these signals. Technology stocks tend to be priced for strong growth, leaving little room for disappointment. When policy risk rises, valuations adjust fast. This creates sharp drops that look dramatic on charts and in headlines. Automated trading and index rebalancing can amplify those moves, pushing prices lower in a short period of time. At the same time, technology stocks are known for powerful rebounds. Innovation cycles, strong balance sheets, and continued demand for digital services often attract buyers after sell-offs. Money flows back in when fears ease or earnings stabilize. This creates wide swings rather than a one-direction collapse. The result is a market defined by volatility. Prices move faster, reactions are stronger, and sentiment shifts quickly as trade news evolves. Trade tensions between major economies rarely stay contained. When the United States and China adjust policy, the effects spread quickly through global markets. Supply chains cross continents. Capital flows move instantly. A tariff announced in one country can change prices, production plans, and investment decisions thousands of miles away. This is why markets in Asia, Europe, and emerging economies often react within minutes of trade-related news. Global companies operate across borders, and their stock prices reflect that exposure. A slowdown in Chinese demand affects exporters in Europe. Higher costs in the United States affect manufacturers in Mexico and Southeast Asia. Commodity markets respond as well, with energy, metals, and agricultural prices shifting as trade expectations change. These moves feed directly into national stock indexes around the world. Investors do not wait for damage to appear in earnings reports. They respond to uncertainty itself. When rules become unclear, risk rises. Funds reduce exposure, volatility increases. Even countries not directly involved in the dispute feel pressure as global portfolios rebalance towards safer assets. Currencies move. Bond yields adjust, liquidity tightens in unexpected places. This is why trade disputes carry outsized influence. They shape expectations about growth, inflation, and stability at the same time. The reaction is less about any single headline and more about the fear of unpredictable change. Markets function on confidence, and uncertainty weakens that foundation across the global financial system. When we step back from the headlines, the full picture is more nuanced than it first appears. The term cancel China sounds absolute, but in reality, it is a policy label describing efforts to reduce dependence, not a complete economic severance. Trade, investment, and supply chains continue to operate, even as governments implement controls and restrictions. The impact is significant, but it is measured and gradual rather than total. Job losses connected to trade with China are real and have shaped parts of the United States labor market for decades. Millions of manufacturing roles were affected as production shifted overseas, and some communities continue to feel the consequences today. At the same time, the overall employment picture is complicated. Not every worker displaced by trade remains unemployed, and shifts into other sectors mask some of the long-term challenges. The story is not simple, and the effects vary by region, industry, and skill level. Technology stocks are under pressure, especially where supply chains and policy risk intersect, but they are far from collapsing entirely. Volatility and swings dominate the narrative, reflecting investor concern rather than systemic failure. Strong companies continue to innovate, generate revenue, and attract investment, even as valuations adjust to new risks. Finally, markets are influenced by a wide array of factors beyond trade or policy alone. Interest rates, inflation data, corporate earnings, geopolitical events, and investor sentiment all interact to drive stock prices. Policy headlines can act as a trigger, but the underlying forces are far broader. Understanding these dynamics is essential to grasping why markets move the way they do and why single narratives rarely tell the whole story. Headlines have a way of grabbing attention, but they often simplify events to a dramatic narrative. Market drops become implosions, policy shifts become collapses, and job changes are called crises, even when the underlying data tells a more measured story. Looking past the sensational language reveals a landscape that is complex and evolving, where numbers and context are essential to understanding the real situation. Economic indicators provide details that headlines often skip. Trade balances, sector-specific employment trends, corporate earnings, and supply chain disruptions all paint a clearer picture of what is actually happening. These data points show that while some industries face real pressure, others continue to grow, innovate, and adapt. Understanding the connections between these elements helps explain why markets react strongly